Inflation. It's the silent thief in your wallet, eroding the value of your hard-earned money. For investors and traders, it's public enemy number one. Why? Because inflation data moves markets. It's that simple. Ignore it at your peril. When prices rise, central banks like the Federal Reserve take notice. Their weapon of choice? Interest rates. A rate hike can curb inflation, but it also slows economic growth. This delicate dance between inflation and interest rates keeps traders on edge. Gold, often seen as a safe haven asset, tends to shine when inflation rears its ugly head. Why? Because gold, unlike paper money, has intrinsic value. It's a tangible asset that has preserved wealth for centuries. On the other hand, Forex, the global currency market, reacts swiftly to inflation data. A currency's value is intrinsically linked to the health and stability of its underlying economy. High inflation. Expect that currency to weaken. The Consumer Price Index, or CPI, a key inflation gauge, measures the average change in prices paid by urban consumers for a basket of goods and services. A rise in CPI indicates inflationary pressures. Gold, a traditional inflation hedge, often rallies when the CPI climbs. For instance, in the 1970s, when the US experienced stagflation, high inflation coupled with stagnant economic growth, gold prices soared. Investors, seeking refuge from eroding purchasing power, flocked to gold. Fast forward to today, the CPI has been on an upward trajectory, fueled by supply chain disruptions, rising energy costs, and loose monetary policy. As a result, gold, after a period of consolidation, has started to glitter once again. Remember, gold is not a foolproof hedge. It can be volatile, subject to market sentiment and speculation. However, in times of high inflation, gold has historically held its value, providing a cushion against the storm. While the CPI grabs headlines, the Federal Reserve favors a different inflation measure, the Personal Consumption Expenditures, or PCE, price index. The PCE tracks the prices consumers pay for goods and services, similar to the CPI. However, there are key differences. Firstly, the PCE considers a broader range of expenditures, including those made by businesses and government programs on behalf of consumers. Secondly, the PCE is a chain-weighted index, meaning its composition adjusts over time to reflect changes in consumer spending patterns. The Fed pays close attention to the core PCE, which excludes volatile food and energy prices. Why? Because core PCE is considered a more reliable indicator of underlying inflation trends. When core PCE rises, the Fed takes notice. The PCE's impact on gold is indirect but significant. A rising PCE, particularly core PCE, increases the likelihood of the Fed raising interest rates. Higher interest rates tend to put downward pressure on gold prices. Why? Because gold, unlike bonds, doesn't pay interest. The Producer Price Index, or PPI, measures the average change in selling prices received by domestic producers for their output. Essentially, the PPI tracks inflation at the wholesale level, before it reaches consumers. Think of the PPI as an early warning system for inflation. Rising PPI can signal future increases in the CPI. Why? Because producers often pass on their increased costs to consumers. For gold investors, the PPI is a valuable tool. A surge in PPI, particularly in key sectors like energy and commodities, can foreshadow rising inflation and potentially higher gold prices. However, it's crucial to remember that the PPI-CPI relationship isn't always linear. Factors like competition and consumer demand can influence how much of the wholesale price increase gets passed on to consumers. The US dollar, the world's reserve currency, plays a pivotal role in the global financial system. It's the currency of choice for international trade, investment, and central bank reserves. But is it a safe haven in times of inflation? The answer is nuanced. In the short term, the dollar can benefit from a flight to safety during periods of global uncertainty. Investors, seeking stability, often flock to the dollar, boosting its value. However, in the long run, persistent inflation erodes the purchasing power of all currencies, including the dollar. Remember, inflation is a monetary phenomenon. When a central bank prints too much money, it devalues its currency. The Federal Reserve's loose monetary policy in recent years, while supporting economic growth, has also raised concerns about inflation. A weaker dollar can make imports more expensive, contributing to inflation. Gold and the US dollar have a complex relationship. They are often seen as competing safe haven assets. During periods of high inflation, investors face a dilemma: gold or the dollar. Gold, as we've discussed, is a tangible asset with intrinsic value. It has historically served as a hedge against inflation. The dollar, on the other hand, is a fiat currency, backed by the faith and credit of the US government. In the 1970s, during a period of stagflation, gold outperformed the dollar. Investors, fearing inflation, flocked to gold, driving its price up. The dollar, weakened by inflationary pressures, lost ground. However, in recent years, the relationship has been less clear-cut. The dollar, despite low interest rates and quantitative easing, has maintained its status as the world's reserve currency. Inflation plays a crucial role in the Forex market. A currency's value is intrinsically linked to the health and stability of its underlying economy. High inflation erodes a currency's purchasing power, making it less attractive to foreign investors. When a country experiences high inflation relative to its trading partners, its currency tends to depreciate. Why? Because its exports become more expensive, while imports become cheaper. This can lead to a decline in demand for its currency. For example, if inflation in the United States rises significantly above inflation in the Eurozone, the US dollar is likely to weaken against the euro. This is because US goods and services become relatively more expensive for European consumers, while European goods and services become relatively cheaper for US consumers. Navigating the markets during periods of high inflation can be challenging. Here are some practical tips for traders. Stay informed. Keep a close eye on inflation indicators like CPI, PCE, and PPI. Understand how these indicators influence central bank policy and market sentiment. Diversify your portfolio. Don't put all your eggs in one basket. Consider diversifying your portfolio with assets that tend to perform well during inflation, such as gold, commodities, and real estate. Look for value. Inflation can create opportunities. Look for undervalued assets that are likely to benefit from rising prices. Manage your risk. Inflation can increase market volatility. Use stop-loss orders and other risk management tools to protect your capital. Be patient. Don't panic. Inflation is a long-term cycle. Stay focused on your investment goals and ride out the volatility. Inflation is a powerful force that can roil markets and erode wealth. Understanding how inflation indicators shape gold and Forex markets is crucial for investors and traders alike. By closely monitoring inflation data, diversifying portfolios, and employing sound risk management strategies, investors can navigate the challenges of an inflationary environment and protect their wealth. Remember, knowledge is power. Stay informed, stay disciplined, and stay ahead of the curve.